Investors, we are about to venture down an entirely different path today, and along the way, it may even get pretty heated with opinions in the comments below that go against your own. Now, I want to get to the bottom of which dividend ETF is a better buy between a defending champion, the all-famous Schwab US Dividend Equity ETF, versus the rather new investor-craved JP Equity Premium ETF. But before we actually get to it, my name is Ari, your go-to dividend investor here on YouTube, looking to keep it all incredibly simple with you, sharing economic insights as well as new dividend stock ideas on a week-to-week basis. However, as for today, we're just going to be solely focusing on our dividend ETF smackdown. So with that, let's dive right in. Now, before I get to breaking down today's two dividend ETFs, I want to start by sharing that there is no better foundation or backbone to an investment portfolio than an exchange-traded fund. Why? Because investing into an ETF does not require any of us to become the next David Blaine of the stock market by picking the winners 100% of the time. And let's face it, that's simply impossible to do anyhow. So sure, you might get it right from time to time, but the more you're actually investing into the stock market, the higher the probability is you're going to get it wrong here and there. However, in my honest opinion, that doesn't mean that you should avoid investing into individual stocks or loading up on them. It just means that you have to play it smart. And that's exactly where ETFs come in. You see, you'll essentially be investing into a basket of holdings, whereas even if some slide one day to the next, the vast majority of them will hopefully continue to perform. In other words, investing into ETFs is a fail-safe strategy, especially if you find yourself invested into the right ones. But what happens when we have two ETFs that both look like they're ideal investments to get invested into? Or perhaps as dividend investors, one has a higher yield. Or maybe one pays monthly versus the other that's paying quarterly. Well, you've come to the right place because we are about to break down two of the most favored dividend ETFs, the Schwab US Dividend Equity ETF and the JP Equity Premium ETF. And hopefully by the end of this video, you're going to have some answers and be closer to investing into one or the other. So let's first break down the most well-known, time-tested Schwab US Dividend Equity ETF, ticker symbol SCHD, which was established in 2011 with a very simple objective: to track as closely as possible, before fees and expenses, the total return of the Dow Jones US Dividend 100 Index. Now, what I love about SCHD is the fact that it really can serve as a core or even just a complement a diversified portfolio, as the stocks within SCHD are selected for their fundamental strength relative to their peers. And speaking of SCHD's holdings, it has 102 of them totaling over $47.2 billion in assets under management, with the largest positions being Broadcom, followed by Verizon, UPS, Pepsi, and Merck. All companies that you're not only familiar with, but dominate their respective industries. Now, ultimately, if we get a little bit broader of a scope here of the portfolio, we can see that it has a hefty sum of assets tied into the industrial sector as well as the financial and healthcare sectors. So all in all, it's safer bets. But that doesn't mean that it's always in the green. And a matter of fact, right now, SCHD is actually down on the year nominally by a little over 3%, coming in at a share price of $71.81 per share, which I would imagine with the latest tech boom and all the bulls coming out to run, a lot of investors are simply jumping out of these safer ETFs. But for all the wrong reasons, because just holding onto SCHD and reinvesting your dividends is where the magic really happens. You see, if you invested $10,000 roughly 10 years ago into SCHD, today you would be sitting on $28,994. That's $18,994 that you otherwise wouldn't have had. And that's icing on the cake because analysts are only forecasting more upside, about 13% worth of it, with a share price coming up to $81.07 per share, along with extremely reliable dividends, with that dividend yield of SCHD is coming in at 3.62%. But this is a dividend smack back down video, so let's break down our second dividend ETF, which is of course the JP Morgan Equity Premium ETF, ticker symbol JEPI, which is a rather new ETF with an inception date dating back to 2020 after two portfolio managers over at JP Morgan got together to establish an ETF that generates income through a combination of selling options and investing into US large cap stocks. Now, of course, their ultimate goal was to deliver through on monthly income from associated option premiums and stock dividends. So when it comes to JEPI, it is our monthly paying dividend ETF of the day. Now, if we pop open the hood and look into this ETF's makeup, we will see it totals out around $27.8 billion in assets under management, with Adobe, Microsoft, Amazon, MasterCard, and Pepsi being some of its top holdings, with the largest position actually being the US dollar. But nonetheless, all in all, it totals 119 holdings that are primarily within the technology sector as well as the industrial and financial sectors. And of course, right now, JEPI, just given the tech boom, has been performing quite well in the year and is actually up by almost 5% year to date, trading for $54.57 per share, with analysts who are only projecting even more upside, almost 12% worth of it, with the share price rising to $61.09 per share. And if we look back into JEPI's track record, it surely delivers. But we can only go back to 2020 and just imagine investing $10,000 at that point in time, because if so, we would have returned $7,817, which is a heck of a return considering that's just over the span of 3 years. Now, what I certainly enjoy when it comes to JEPI is the dividend, and its dividend yield is coming in at 10.57%. So now, which is the better buy here for the forever hold investor? Well, perhaps we can actually take a look into these expense ratios, where SCHD is coming in at just 0.06% versus the JEPI's expense ratio at 0.35%. That's $6 per $10,000 invested versus $35 per $10,000 invested. But even with a higher expense ratio for JEPI, I don't believe, given its growth capabilities, is worth ruling out. Now, in my honest opinion, these are both solid dividend ETFs for a portfolio, and perhaps we should all consider room for both of them in our portfolios. But now let me know your thoughts by dropping the comments down below. Hold absolutely nothing back and comment away. Oh, and don't go too far for the next video. That's all you have to do is click right here. And of course, before you actually do so, make sure you tap on that thumbs up button to let me know that this video was of value. Most importantly, subscribe to never miss a single video.